Which Bilt 2.0 option is actually better? Bilt Cash versus Tiered. Before we dive in, some ads may appear during the video. Your support allows this channel to keep sharing valuable information for free. Now let's dive in. Bilt just restructured everything. And if you haven't gone back to your dashboard and made an active choice between their two new earning options, you may already be leaving real capital efficiency on the table. Today, I'm going to give you the full institutional breakdown of Bilt Cash versus the Bilt Tiered reward structure. Not the surface-level overview you'll find on personal finance blogs, but the same analytical lens that wealth advisory firms apply when evaluating credit instruments as part of a broader capital allocation strategy. Here's exactly what you'll walk away with: a clear understanding of how each option functions as a financial mechanism, not just a rewards vehicle, the specific cardholder profile that benefits most from each path, how your entity structure and income type should influence your decision, and a definitive verdict on which option delivers superior long-term value. Pull up a notes app. What I'm breaking down today is the kind of analysis that boutique financial planning firms typically package into a paid engagement. Let's start at the foundation of the Bilt 2.0 strategic framework, because too many cardholders are treating this as a simple preference question when it's actually a capital efficiency question. Bilt's restructuring introduced a meaningful fork in the road. You either opt for Bilt Cash, a simplified dollar-denominated return on spending, or you stay within the tiered rewards architecture, which preserves your access to Bilt points and their transfer partner ecosystem. Those are structurally different instruments, and they serve fundamentally different financial profiles. When we examine Bilt Cash through an institutional lens, what you're really looking at is a cost-basis reduction tool. Bilt Cash functions as a predictable, low-complexity return that applies directly against your rent obligation, one of the largest fixed liabilities on most household balance sheets. For retirees on fixed income, for business owners who hold real estate in personal names, or for executives in a high-income phase who prioritize simplicity and tax-clean treatment, the Bilt Cash option offers something that the rewards world rarely delivers: certainty. There is no valuation debate, no redemption optimization, no concern about devaluation cycles from a loyalty program. $1 earned is $1 applied. When you think about Bilt Cash as a mechanism to reduce your effective cost of housing, one of the few expenses that is both fixed and substantial, it begins to look less like a rewards program and more like a passive offset strategy embedded directly into your monthly cash flow. Now let's examine the opposing architecture. The Bilt tiered structure retains access to Bilt points, and the institutional argument for staying in this lane centers entirely on point liquidity and transfer optionality. Bilt has one of the most strategically constructed transfer partner networks in the domestic market, covering both airline and hotel programs, including several that historically yield outsized redemption value when timed properly against premium cabin availability or aspirational hotel categories. For business owners running international operations, for executives whose travel expenditure is a meaningful line item, or for investors who understand that points, when treated as an alternative asset class with disciplined redemption methodology, can generate returns that numerically exceed what a cash-equivalent instrument would deliver. The tiered structure is categorically superior in those scenarios. The Bilt tiered transfer partner value proposition rests on a concept that institutional analysts call redemption optionality. Unlike cash, which has a fixed ceiling, points carry a variable upside that is unlocked through strategic execution. A business class redemption to London or Tokyo, for instance, can represent a cost basis reduction of several thousand USD when measured against the cash price of that same seat. That is not hyperbole, that is arithmetic. However, and this is the critical caveat, that upside is only accessible to cardholders who have the time, the flexibility, and the analytical bandwidth to actively manage their redemptions. For many in this audience, that cost and attention may itself be a real cost. This is where entity structure and card selection intersect in a way that most cardholders never consider. If you are operating through an S-Corp or LLC and you are running personal expenses, including rent, through a structure that captures deductibility where applicable, your relationship with the Bilt card changes. The simplicity of Bilt Cash creates clean, auditable records with no ambiguity around point valuations, which matters significantly during substantiation processes under IRS guidelines. Points-based rewards, particularly when redeemed for travel, introduce valuation questions that, while manageable, require additional documentation discipline. For business owners prioritizing clean tax treatment, Bilt Cash offers a lower friction path. Let's run the capital efficiency annual cost analysis with real numbers, because that's how institutional decisions get made. If your monthly rent is $2,500 US, that is $30,000 US annually flowing through the Bilt card. Under the cash option, you are generating a predictable dollar-denominated offset with zero execution risk. Under the tiered structure, you are generating points that, conservatively managed, may return 1 to 1.5 cents per point, and aggressively optimized toward premium redemptions, potentially 2 to 3 cents or more. The spread between conservative and aggressive execution in the tiered model can represent several hundred to over 1,000 USD in additional annual value on that same rent spend. That spread is real, but so is the execution risk. This brings us to the risk-adjusted return comparison, the framework I'd apply if this were a client portfolio conversation. Bilt Cash is a low-volatility instrument. Its return is predictable, its tax treatment is straightforward, and it requires no active management. Bilt Tiered is a higher upside instrument with variable execution requirements. The correct choice is not determined by which option sounds better in a thumbnail. It is determined by your personal liquidity needs, your travel behavior, your tax situation, and your appetite for managing a reward strategy with the discipline it requires to deliver superior returns. Historically, the cardholders who underperform in tiered rewards programs are not those who chose the wrong option. They are those who chose the high upside option and then managed it passively. Let me give you the decision matrix by cardholder profile, because this is where the analysis becomes actionable. If you are a retiree or pre-retiree with a stable, fixed income structure and limited international travel, Bilt Cash is almost certainly your optimal path. The simplicity premium is worth accepting a lower theoretical ceiling. If you are an active business owner, an executive with significant travel expenditure, or an investor who actively manages financial instruments and treats optimization as standard practice, the Bilt tiered structure has a quantifiably higher ceiling, and your existing skill set makes the execution risk manageable. If you sit between those profiles, the determining variable is typically this. Do you fly internationally at least twice per year in a premium cabin? If yes, the transfer partner ecosystem in the tiered model almost always wins the arithmetic. If no, Bilt Cash may serve your capital efficiency objectives more reliably. Before we end, let me summarize the critical insights from today's analysis. First, Bilt Cash and Bilt Tiered are not variations of the same product. They are structurally different capital instruments that serve different financial profiles. Treating this as a casual preference decision is a strategic error. Second, Bilt Cash delivers cost basis reduction on your largest fixed liability with predictable, tax-clean treatment and zero execution overhead. For retirees and simplified balance sheet structures, this is a genuine institutional advantage. Third, Bilt Tiered preserves access to transfer partner liquidity, an asset class with measurable upside, historically yielding 2 to 3 cents per point on optimized premium redemptions. That upside is real, but it is execution dependent. Fourth, your entity structure should inform this decision. S-Corp and LLC operators who prioritize IRS substantiation clarity will find Bilt Cash's dollar-denominated simplicity reduces documentation friction in ways that compound over time. Fifth, the risk-adjusted return calculus favors Bilt Tiered for active, travel-oriented cardholders and Bilt Cash for passive, stability-oriented cardholders. The worst outcome is choosing tiered and managing it passively. That is where value erodes. Sixth, and this is the verdict, for the majority of this audience, business owners and executives who travel meaningfully and manage financial decisions with the rigor this analysis reflects, the Bilt Tiered structure, actively managed, delivers superior long-term capital efficiency. But if simplicity, tax clarity, and passive execution are your operational priorities, Bilt Cash is not a concession. It is an entirely legitimate and strategically sound choice. Please subscribe for more institutional-grade credit and capital strategy that you won't find anywhere else on YouTube. If this analysis delivered value, click the thumbs up. Drop a comment below with your questions or topics you'd like me to cover next. Disclaimer: I am not your financial advisor. This content is for educational purposes only. Consult with qualified professionals before making any financial decisions.